Tesla Shorts Time Daily, episode 434. Hey, good to have you here. It's Patrick in Vancouver, and this is Tesla Shorts Time Daily for April 12th, 2026. Let's get into it. Tesla's full self-driving software just cleared its first major European regulatory hurdle. Dutch authorities have officially approved supervised FSD after more than a year of careful testing and data collection. That makes the Netherlands the first country in Europe to green light it, which feels like a genuine breakthrough after all the back and forth we've seen with European regulators. What stands out to me is that they signed off on Tesla's pure vision-only system. European safety standards are famously strict, and the fact that cameras plus neural nets could meet those requirements, even with a version that's tuned a bit differently than what's running in North America, is a solid validation of the approach Elon and the team have been doubling down on for years. For Dutch customers, this could mean supervised full self-driving shows up on public roads in the coming months, which is pretty exciting if you live there. Of course, the broader European Union picture is still complicated. Every other country will need its own review, and that process could drag on for a while, depending on how willing individual governments are to move. Still, getting that first crack in the regulatory wall matters. It proves the system can satisfy regulators on this side of the Atlantic, and that should give the whole autonomy effort a bit more momentum. While that regulatory door is finally opening in Europe, Tesla is also quietly rethinking the more affordable end of its vehicle lineup. Reports confirm the company has restarted serious development on a lower-priced electric vehicle, and this time it's shaping up as a compact SUV rather than a hatchback. This revives plans that were essentially put on ice last year when Tesla shifted its engineering resources toward the robotaxi and Optimus projects. It's the kind of strategic pivot we've seen from them before. Double down on the future stuff, then circle back when market conditions shift. The timing makes sense. Competition in the affordable EV space is heating up fast, with several manufacturers rolling out smaller, cheaper battery electric offerings that are starting to eat into what used to be Tesla's clear territory. From a pure business standpoint, bringing a compact SUV to market could open the door to a much wider customer base, people who want an EV but don't want to pay premium prices. That kind of volume growth would help Tesla spread its fixed manufacturing costs, improve overall margins, and give the company more breathing room as it keeps investing in autonomy and energy. It also shows a refreshing willingness to adapt. Tesla isn't married to a particular product roadmap if the real world tells them something different. That flexibility has served them well in the past, and it looks like it's showing up again here. Speaking of scaling up in new directions, Tesla just took a very concrete step on the commercial truck side. The company has revealed a dedicated factory in Nevada that's been purpose-built from the ground up to produce the Semi. This isn't just adding another line inside an existing building. It's a full standalone facility focused entirely on ramping the long-promised Class 8 electric truck. For years, the Semi has been one of those when-it's-ready products, and this new plant feels like Tesla is finally putting real capital and floor space behind the promise. From an industry perspective, this is a meaningful signal. Heavy-duty trucking has always been one of the tougher segments to electrify because of the range, payload, and duty cycle requirements. But if Tesla can actually scale production and deliver on the efficiency numbers they've talked about, logistics operators could see some serious long-term savings on fuel and maintenance. It could also light a fire under competitors who have been moving more cautiously on battery electric big rigs. We've seen a few announcements, but nothing that matches the scale Tesla seems to be preparing for. From the heavy end of the vehicle spectrum, we swing all the way to the complete opposite, the tiny purpose-built robo-taxi. A fleet of cybercabs has now been spotted moving around Giga, Texas, and the consensus from those who've seen them is that volume production ramp might actually be underway. These aren't prototypes or hand-built show cars anymore. They look like finished vehicles rolling out of the factory, which moves the whole robo-taxi conversation from beautiful renderings and keynote slides into something you can actually see and touch on the production floor. For Tesla's business model, this is potentially huge. If unsupervised autonomy works at scale, the Cybercab could open up an entirely new high-margin revenue stream that isn't tied to traditional vehicle sales. We're talking about a future where the company owns a large chunk of a robotaxi network instead of just selling the hardware once and moving on. That would be a fundamental shift in how Tesla makes money, and the pace at which they can ramp these things over the next few quarters is going to be one of the most important metrics to watch. While the robo-taxi future is starting to feel more real, US regulators just gave one of Tesla's existing convenience features a clean bill of health. The National Highway Traffic Safety Administration has officially closed its investigation into the remote parking assist feature with no recall or further action required. That quietly removes a regulatory shadow that had been hanging over the product for months. For owners, it's reassuring to know the feature isn't going anywhere and will likely keep getting better through over-the-air updates. It also highlights something we've seen before. Tesla's massive real-world driving dataset sometimes lets investigations wrap up faster than they do for traditional automakers who rely on more limited crash data. From a customer experience standpoint, it's nice when the safety agency looks at the evidence and says, essentially, there's no systemic problem here. It builds confidence. Good news on the regulatory front in the US, and on the sales side in Europe, Tesla continues to dominate an important chart. The Model Y was Germany's best-selling electric vehicle again last month. That's Europe's largest EV market, and it's impressive that Tesla's highest volume product is still sitting at the top, despite all the new competition that's arrived and the broader headwinds the EV segment has faced in some countries. It's a reminder that when buyers are making real purchasing decisions, things like proven range, access to a reliable charging network, and everyday usability still carry a lot of weight. The Model Y isn't the flashiest choice anymore, but its practical advantages keep winning. That strength should give current owners and anyone thinking about buying one in Europe a bit more confidence that they're backing the right horse. Strong sales performance in Europe stands in pretty stark contrast to what we're seeing with inventory levels back in North America. Tesla is currently sitting on noticeably higher vehicle inventory than it has carried in recent memory. If you follow the right accounts or drive past some of the larger staging lots, the buildup is hard to miss. This could be a sign that demand has softened in certain markets, or it might be a deliberate decision to keep more cars on hand so deliveries can happen faster once orders come in. Either way, it creates a real operational challenge. Production capacity has clearly outrun immediate sales momentum in some regions, and the company will need to manage that surplus without resorting to heavy discounting that would hurt margins. We've seen Tesla adjust build rates quickly in the past, and software updates that improve the cars already sitting on lots can help move inventory organically. Still, how they balance production with demand over the next couple of quarters will tell us a lot about execution in this environment. It's a legitimate near-term pressure, but not an existential threat given how nimble they've been before. That inventory situation is probably one of the reasons Tesla and SpaceX are both pushing even harder on vertical integration across their supply chains. Both companies are deepening their control over critical components and raw materials instead of relying as heavily on outside suppliers. The goal is pretty straightforward: better cost control, more consistent quality, and the ability to innovate faster without waiting for someone else's roadmap. For Tesla, this strategy touches everything from the vehicles to the energy business to the specialized hardware needed for AI training and inference. It's a philosophy the company has followed for a long time. Own the pieces that matter most rather than hoping the broader industry will deliver exactly what you need when you need it. That same mindset is now showing up in the semiconductor world as well. There's growing discussion in the community about closer ties between Tesla, xAI, and Intel, particularly around the possibility of using Intel's US-based 18A foundry process for next-generation AI chips. If that relationship develops, it could give Tesla access to leading-edge compute that's both more powerful than what they're constrained to today and manufactured domestically. That would make scaling Dojo, the in-car AI computers, and the hardware for Optimus a lot smoother without being completely dependent on overseas suppliers. It also has implications for national supply chain resilience in a technology area that's becoming strategically important. Vertical integration at the silicon level would be a natural extension of how Tesla already thinks about batteries and power electronics. Even while all these big bets on AI, autonomy, and robotics are moving forward, Tesla hasn't completely taken its eye off the cars that still pay the bills today. They've just added a new Zen Gray interior option for the Model Y. It's a relatively small change, but it gives buyers another aesthetic choice on the company's highest volume product. To me, this is a healthy sign. Even as the company pours resources into robo-taxis and humanoid robots, it's still polishing the vehicles that generate the majority of current revenue and keep customers happy in the short term. For someone ordering a Model Y, it's a nice bit of extra personalization that doesn't change performance or pricing. It shows Tesla can still walk and chew gum at the same time. pursuing moonshot initiatives while making incremental improvements to the cars that are on the road right now. On the analyst side, there's continued confidence in Tesla's vision-only approach for robotaxis, despite the near-term pressure on vehicle sales. The argument is that a camera-based system, once it reaches the necessary reliability, should ultimately be cheaper to scale than setups that rely on multiple types of sensors. That cost advantage could become very important if robotaxis are going to make economic sense at high volume. What's interesting is how the conversation is becoming more grounded in engineering realities instead of pure hype. At the same time, it's clear Tesla is shifting more of its focus and resources toward the higher potential businesses of autonomy and robotics, while traditional car sales face some headwinds. That strategic pivot is happening in plain sight. We're also hearing fresh reporting that the affordable EV project we talked about earlier is indeed gaining momentum again in the form of that compact SUV. A lot of people had written the idea off after the earlier delays, so seeing it come back to life suggests Tesla is still committed to expanding its lineup downward once it can free up the necessary production capacity. On the charging infrastructure side, Tesla's new online configurator for commercial supercharger deployments is giving fleet operators and site owners a clearer picture. The all-in price for a meaningful installation sits around $940,000. That kind of transparency is helpful, but it also drives home just how expensive it still is to roll out fast charging at real scale. The conversation now is shifting toward what utilization rates, business models, or potential partnerships are needed to make those numbers work economically over time. Interestingly, even though Tesla basically invented the modern over-the-air update experience, BYD has reportedly taken the lead in how frequently and effectively their vehicles receive new features. That reversal is worth paying attention to. It raises real questions about execution speed and iteration cadence inside Tesla. For a long time, it felt like a given that Tesla would always dominate the software-defined vehicle space. But competition has a way of sharpening everyone. In the end, customers are the ones who benefit when multiple companies push hard on frequent, useful updates. Before we wrap up, one thing I'm watching closely is exactly how that record inventory situation plays out. Sitting on more vehicles than usual can tie up capital and put pressure on pricing if it isn't managed carefully, especially with softer demand in some markets and increased competition. That said, Tesla has shown it can adjust output quickly, and clever software improvements can make the cars sitting on lots more attractive without heavy discounting. How management balances build rates with real demand over the next few quarters will be a pretty good indicator of how they're navigating the current environment. It's a real short-term challenge, but not an existential one. And just as a broader thought while we're here, it's worth applying first principles thinking to the battery chemistry debate that keeps coming up. A lot of people assume the chemistry with the highest energy density will automatically win in every application, yet LFP cells are powering a growing share of electric vehicles worldwide, even though they give up some range per kilogram. Their lower cost, longer cycle life, and better inherent safety often deliver superior total ownership economics for many real-world use cases. The real question isn't which chemistry is objectively best, it's which combination of vehicle size, daily duty cycle, local electricity prices, and climate makes one chemistry deliver meaningfully lower lifetime cost than another. In warm climates with moderate daily distances, LFP's advantages in upfront price and durability frequently win. In larger vehicles or cold weather markets, the extra range and faster charging of nickel-based cells can still make more sense. Tesla seems to treat battery chemistry as just one variable inside a much larger system-level optimization that also includes vehicle architecture, thermal management, charging access, and smart software. They use different cell formats in different regions and different products rather than betting everything on a single winner. That pragmatic, context-aware approach might end up being more profitable in the long run than chasing one universal best chemistry. It's a good reminder that context usually matters more than the conventional wisdom wants to admit. All right, before we go, keep an eye on how quickly those Cybercab production numbers actually ramp and whether any additional European countries start signaling movement on full self-driving approvals in the coming weeks. Those two threads feel like they could shape the next chapter. That's your Tesla news for today. TSLA closed at $348.95, up $4.02 or 1.2%. If you found this useful, a rating or review on Apple Podcasts or Spotify really does help new listeners discover the show. You can also find us on X at Tesla Shorts Time. I'm Patrick in Vancouver. Thanks for listening, and I'll talk to you tomorrow. 478. This podcast is curated by Patrick but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.